How the economic machine works in 30 minutes.
This is a critical commentary to the video How the Economic Machine Works, published by legendary hedge funder Ray Dalio. After a short overview of the main problems and issues in Mr. Dalio's template, we'll go through the whole video in chronological order. The video is very demonstrative, and we definitely need more videos in this style explaining basic economic concepts and mechanisms. Unfortunately, this one ends up fortifying some simple but severe misunderstandings regarding our current monetary system, which also caused Mr. Dalio to jump to completely illogical conclusions of causality and fail to see an even better and simpler solution for achieving a beautiful deleveraging. The main pitfall in Mr. Dalio's credit cycle template is what we could call the fallacy of external debt. The idea that mankind as a whole could be net indebted in monetary terms, as if to some kind of external debt monster in space or God, when in reality, all monetary debt is to some other person or human-made institution, and the existence of a credit system does not allow mankind as a whole to live beyond its means, not even in the short run. The only way the global economy can live beyond its means is by deteriorating natural resources or other real assets. As Mr. Dalio points out, one party's liability is another party's asset, one party's debt is another's credit. If the borrowing by some weren't accompanied by others saving, then the increased competition over labor and other resources would only lead to accelerating inflation. When there is too much involuntary debt, a situation where people can't pay their debts back, it is practically caused by others saving too much as monetary assets. This omission of the two-sided nature of debt relationships and the impacts of the profitability of holding on to credit is a rather common fallacy that dominates economic thinking both among the general public and many economic schools. In Mr. Dalio's video, further confusion is caused by incoherence in the used terminology, especially the inconsistent way Ray distinguishes between money and credits, and this whole idea of GDP exceeding the amount that is produced. When GDP, the gross domestic product, by definition is the value of goods and services produced within a nation. The amount consumed within a nation can exceed the amount produced there, but that has nothing to do with debt cycles, and it is not possible on the level of the whole global economy. Unless you have a time machine, you cannot consume goods and services that have not been produced by someone. No disrespect whatsoever is intended towards Mr. Dalio's successes and authority in the investment business, and his template sure seems to have served him well. However, this does not mean that the template would keep on applying in the future, or that it would be the only causal model that can explain past observations. This historicist attempt of trying to identify patterns in the scale of centuries is especially dangerous, as the structure of our economy and especially our monetary system have changed significantly. One very dramatic change being the rise of electronic banking and payment systems during the past 2 decades, which has rendered physical cash, notes and coins almost redundant in developed economies. Understanding this monetary system, the basic laws of supply and demand, and theories of interest provides a simple solution to deleveraging the current economy stably and fairly without significant wealth transfers, which is what Dalio's suggested policies would inevitably cause. This other solution would almost eliminate cyclicity, which is not caused by human nature as Ray insists, but rather by a simple bug in how the labor market operates. This solution would be to facilitate negative real interest rates either by eliminating physical cash to allow them nominally or adopting a higher target inflation rate, to make sharing work profitable for employers in order to remove the self-reinforcing mechanism of reduced demand increasing economic insecurity, to put a price on the government guarantee on deposits to make holding on to risk-free credit less profitable without making borrowing cheaper, and to tax land according to market value to prevent negative interest rates from causing harmful hoarding in the real estate market. The logic and economic models behind these solutions are explained in more detail in the videos at therootdebugged.org and in the upcoming book Fixing the Root Bug. Having seen or read these will aid in understanding this commentary but is not necessary. The focus here is on pointing out inconsistencies and false conclusions in Mr. Dalio's video, while giving credit to some very important points it makes. Any further comments are welcome, and please do point out if there is something that this commentary is seriously mistaken about.
The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years.
Actually, this video very well reflects how many mainstream economists and politicians think about the economy.
Let's begin. Though the economy might seem complex, it works in a simple, mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets.
Here, as we will see later, it would be useful to distinguish transactions related to new production from transactions of existing assets like financial assets, already constructed real estate, and second-hand goods. The former are included in GDP, the gross domestic product, which is how the size of the economy is usually defined, and contribute towards the total demand for labor. But for example, an increase in stock market turnover does not increase GDP except for the transaction fees.
Credit spends just like money, so adding together the money spent and the amount of credit spent, you could know the total spending.
As mentioned, this distinction Ray makes between credit and money is rather confusing. All money in our current economic system is liquid credit, and it is all created by some other party taking on debt. We can and we should distinguish between central bank money and retail bank money, but cash is the only form of central bank money that consumers ever get their hands on and is rather insignificant in today's developed economies.
The total amount of spending drives the economy. If you divide the amount spent by the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So, if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy.
This is a very sticky myth that plagues many economic schools. The central bank in our current system has hardly any control over the total amount of liquid credit in the economy. We say that money is endogenous, in other words, determined by the market.
It does this by influencing interest rates and printing new money.
This expression of printing money is rather misleading and dates back to a time when physical cash was the most liquid form of money available. The central bank does have more direct control over the amount of central bank money in the economy, the amount of liquid central bank credit. Quantitative easing, which is usually what is meant by printing money, has little to do with printing actual notes, but is practically the central bank buying up other assets on the market and replacing them with liquid central bank credit. This mainly has the effect of increasing liquidity between banks, but because the amount of central bank money is tiny compared to the amount of retail bank money in the economy, this does not notably increase the amount of money available for consumers and companies.
For these reasons, as we'll see, the central bank is an important player in the flow of credit. I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood.
Agreed, and this video partly serves to show how badly it is understood.
It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air.
This is very true, and this is exactly why the terms lender and borrower are in this context very misleading. Granting credit is not the same as lending a physical object to someone, like a frisbee over the weekend. It is simply accepting to expect a payment in the future. Banks do not lend out any money that they have, but simply create new debt contracts, carry their default risks, and make the credit part liquid with their payment services. But despite this risk of confusion, we can still agree to refer to taking on debt as borrowing and taking on credit as lending.
That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled.
Now, this is very true and extremely important to understand. But what Ray fails to explain here is that when a bank grants a loan, there are in fact two credit contracts that are created. One is the borrower's mortgage or other debt to the bank, which is the borrower's liability and the bank's asset as shown here. And the other is the new money created on the borrower's account, which we misleadingly call deposits. The deposits are the borrower's asset and the bank's liability, that is, before he spends them.
So why is credit so important? Because when a borrower receives credit, he is able to increase his spending.
Exactly. And only when the borrower spends this new money, the credit that is backed by the bank and the government, does he become net indebted. Until then, the bank owes him almost as much as he owes the bank.
And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more.
This is called the circular flow of income and is something really important to understand.
When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles.
What Ray seems to assume here is a constant circulation velocity of money, that the buffers of credit held by people and companies do not change. But the economy can also grow without an increase in borrowing or the amount of credit if people spend off their savings faster. We'll return later to why economic cyclicity is not caused by changes in the amount of credit.
In a transaction, you have to give something in order to get something, and how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth.
Yes, the size of the economy is the value of the goods and services produced, and hence, long-run economic growth potential is limited by our ability to produce, our productivity. The most common definitions of the term productivity do not include the amount worked, and hence, the economy can also grow by people working more or by more people working. But Ray here seems to define productivity as the amount produced per person. And he also seems to be talking about GDP per capita instead of the whole GDP, as he ignores the effects of population growth.
Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back.
For an individual or a non-closed national economy, yes, but not for the whole global economy. But even as this graph would be only talking about one nation's economy, there is a massive conflict of definition. As GDP is the value of the goods and services produced, we cannot have a GDP which is more than we produce. And if a nation would be consuming more than it produces, in other words spending more than it earns, that is facilitated by foreign loans and investments, not by its own citizens borrowing from its own banks.
Debt swings occur in two big cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close, day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, the economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations, it's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self.
And this analogy is where the logic of this credit cycle theory fails. Robinson Crusoe cannot borrow from his future self alone on an island. When you are taking on more debt and presumably borrowing from your future self, you are also borrowing from a current someone else.
In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy.
No, it is not. The amount of credit alone does not cause economic cycles, and what applies to you might apply to a single national economy like the US economy, but not to the whole global economy, which is a closed system.
This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled.
Here, it is easy to confuse two different meanings of settling a payment or debt. In one definition, the payment or debt is settled when the seller or creditor no longer bears the default risk of the buyer or debtor. In this sense, paying a beer with a credit card or a bank transfer is just as much settling the payment as paying it with cash, which is just central bank credit. Cash and electronic money on retail banks' accounts are both equally risk-free credits, as bank deposits are ultimately guaranteed by the government if the bank were to go bankrupt. If we define settling as the moment when all credit disappears, then with either form of payment, the payment is only settled when the bar owner buys something else with that money. Or if the bar owner, for example, has a mortgage on the bar, he's practically settling that mortgage by selling beers.
The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion.
What Ray here calls money is central bank money or high-powered money, or the monetary base, which is composed of physical cash and the electronic money that retail banks hold on the accounts that they have on the central bank.
Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards.
Yes, credit is good when it can be paid back, and it is bad when it cannot be paid back. And assessing these default risks and the creditworthiness of debtors is one of the main businesses of retail banks. But it is not always so that lending for productive investments would be better than for consumption. Giving a loan to a startup company with high leverage and little collateral is extremely risky, while granting a consumption loan to a person with reliable income and high solvency due to large, broadly diversified investments is much safer and not in any way harmful to the economy. This centuries-old Protestant work ethic where production is always good and consumption is always bad seems to be strongly affecting our economic thinking, and making us forget that investment into new productive assets only makes sense if the consumption of goods and services produced with those assets is expected to increase in the future.
In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000 even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern.
As said, Ray here is assuming a constant circulation velocity of money, in other words, fixed buffers of credit, and ignoring the fact that people can also spend off their savings. Moreover, if net creditors save up more than others borrow, then the amount of debt in the economy can grow without the economy itself growing.
But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation.
This is a slightly oversimplified way of putting it. If the amount of resources available wasn't limited, in other words, their supply was infinitely price elastic, increased consumption would simply result in increased production. And as the most important resource in production is labor, inflation is usually practically caused by the demand for labor exceeding its supply, or other factors causing pressures to raise wages.
The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend, so spending slows.
Yes, when interest rates are higher, people are less inclined to borrow more and more eager to pay back their debts, and that is very likely to reduce total spending. But what Ray and many economics schools here omit or downplay is the fact that it also makes those without debt more eager to save as they get higher returns on their savings and other investments. This too is likely to reduce spending, but both of these factors can also encourage people to earn more, assuming that they have a say in how much they work. In this way, the central bank's interest rates affect the aggregate supply and demand for labor, which causes raising or lowering pressures for wages, which affects the general price level, the rise in which is inflation, not by affecting the amount of credit in the economy. However, this income effect of higher interest rates reducing people's income available for consumption does not apply on the level of the whole economy. This is simply because all debtors' interest expenses are some other parties, the creditors' interest income. While mortgage holders might have less income to spend and invest, savers and bondholders will have more. If not, then the bank has more to invest or to distribute to its shareholders, who then have more to spend and invest.
And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank.
This animation is rather misleading. Although the central bank lowers interest rates in recessions, it raises them rather quickly when the economy starts growing again to prevent inflation from getting out of hand. So interest rates are actually high during most of growth periods. The central bank is not causing these fluctuations, but rather attempting to compensate for fluctuations caused by uncertainties in the labor market, as will be explained. In the 19th century, before our current central banking system, interest rates reacted too late, and they actually correlated positively with the price level. These observations were referred to as Gibson's paradox because they didn't fit very well together with the predictions of classical models that expected banks' lending to be constrained by the amount of saving.
The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature.
To repeat, it is not possible for the whole economy to be net indebted. If we tend to end up in situations where some people are in a lot of debt and do not have the earning opportunities to be able to pay those debts back, that rather tells of a human natural tendency to hoard credit. And making collecting money a game and an end in itself seems to be a tendency that our morality supports, as work is a virtue and consumption is a vice. But especially in depressions, it is more economic insecurity that promotes this tendency to want to indebt others as much as possible.
Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately. And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble.
When people spend a lot due to high perceived income security, that is not called a bubble. A bubble is when the price of an asset rises faster than its actual future income generation potential would allow, usually due to exuberant expectations. As for productive assets, their income generation potential tends to very much depend on the expected future total demand, and therefore economic upturns tend to come with bubbles that are based on the expectation of the growth continuing.
So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever.
If a bank assesses the creditworthiness of its debtors without taking depression risks into account in terms of both the debtor's income and the value of any collateral, it is either a very stupid bank or expecting a government bailout in the case of that depression.
And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending.
As said, this income effect is a big load of bull. Net creditors would still have a lot to spend, and if they would not spend and invest that credit, the central bank would have to bring the interest rates down to fend off the deflationary pressures caused by the reduced demand. And when the interest rates drop, also servicing the existing debts becomes easier. The main reason why Western countries and Japan end up stuck in the depressions in which they are now is that interest rates cannot be made negative enough to make it unprofitable to hoard credit excessively.
And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further. And the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor.
Except for the ones holding on to risk-free credit, the bonds and cash. Of course, the same investors usually tend to have a part of their portfolio as stocks and real assets, the value of which drop.
Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%. So the stimulation ends.
And this zero lower bound of interest rates is one of the main bugs in our current economic system. Referring to the central bank's conventional monetary policy of adjusting interest rates as stimulus is a bit misleading, as the central bank is just practically replacing the market mechanism for interest rates, which doesn't work with any commodity money. When aggregate supply exceeds aggregate demand, interest rates have to drop even if they were already at zero. The zero lower bound is practically a minimum wage for unemployed capital. And as with any price regulation or overly generous unemployment support, it is bound to distort the market. In this case, a chronic oversupply of saving capital.
Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1. People, businesses, and governments cut their spending. 2. Debts are reduced through defaults and restructurings. 3. Wealth is redistributed from the haves to the have-nots. And finally, 4. The central bank prints new money. These 4 ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall.
Exactly. This is called the paradox of thrift. If everyone tries to save as monetary assets, no one will be able to do so. Net wealth in the global economy can only increase as real assets. However, if net creditors spend off their savings while net debtors practice austerity and spend less, then the amount of debt can decrease. Also for the government. This is what negative interest rates would allow. It does not make sense for the government to fall further and further into debt just to facilitate the private sector's excessive saving.
They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment.
And this is the other bug in the economy that causes the self-reinforcing effects of cyclicity. The fact that reduced demand causes some people to lose their earning opportunities altogether. This results in further reduced spending as those still working are afraid of losing their jobs as well and start saving for a bad day. If it were profitable for employers to cut work from within people instead of as whole people, no one would have to fear for long-term unemployment for cyclical or structural reasons, and the lowering income would eventually prevent excessive saving.
This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank.
This is called a bank run. but it shouldn't be a problem in the current system for nations with their sovereign currencies, as long as the government sticks to its deposit guarantee, which makes bank deposits just as safe as cash.
Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary.
This claim is questionable, as reduced debts should make debtors less desperate to work for lower wages and should encourage creditors to spend off their credit before they are further cut.
All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes.
And this is yet another reason why it is so stupid that the government taxes transactions so much. If the government would rather be taxing land, and for example be able to receive negative interest rates on its debts in the case of a depression, the effects on government income would not be half as bad.
At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode in a deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots.
Trying to redistribute wealth by raising the income taxes on the wealthy isn't very effective because their current wealth remains untouched, and also it isn't very fair or encouraging them to employ their labor and capital to the most productive use. Instead, facilitating negative interest rates would lower the yields on risk-free credit, encouraging investments in productive assets, but simultaneously reduce the profit requirements of all these assets, making it harder for wealth to pile up more wealth.
The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds.
Yes, this is exactly what quantitative easing is.
It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits.
Here, Ray has it extremely correct. As the past 5 years have shown in practice, quantitative easing alone is very ineffective at raising inflation in the short run, as it does not increase the demand for labor. However, fiscal stimulus through selling bonds to the private market has almost exactly the same effect as stimulus through central bank financing, especially when the bonds are sold to private banks that can create new liquidity. The main difference is that the government has to pay slightly higher interest on bonds than on deposits of central bank money, and that quantitative easing, when not directed at bonds already owned by banks, increases excess liquidity in the market, which can increase the risks of hyperinflation.
This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained.
Or, instead of taking all these risks and subjecting itself to the cross-firing demands of interest groups trying to get most of the wealth transfers to themselves, the government could simply facilitate negative real interest rates by either adopting a higher target inflation rate for the central bank or eliminating physical cash. Land taxation is of course also necessary to prevent those interest groups from exploiting each other by building and bursting another real estate bubble.
People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money.
As said, it is not feasible to assume a constant circulation velocity of money. Ray seems to strongly believe in the quantity theory of money, which assumes a relationship between the amount of money and the amount of money spent. However, this explanation is very close to the post-Keynesian suggestion that the government should compensate for private saving with public borrowing. However, the problem is that if and when the private demand for saving suddenly drops, the government has no way of collecting in enough credit in a short time to prevent this sudden burst in spending from causing the chain reaction of a hyperinflation.
In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden.
Just like the earlier proposed income effect of interest on aggregate demand, this claim makes little sense. Even if your income didn't grow at all, you can definitely pay off debts that have a positive interest rate. This just requires that creditors spend off more than they earn interest and other income together.
You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again, leading to the reflation phase of the long-term debt cycle.
The trouble with the current situation compared to that 80 years back is that most people in the Western world are no longer living hand to mouth, and that new production technologies are often much less capital intensive than they were back then. This, together with increasing demonization of consumption due to environmental concerns, might lead to a situation where we have a chronic oversupply of capital even without the uncertain environment of a depression, unless we facilitate negative enough real interest rates.
Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests. However, laying the short-term debt cycle on top of the long-term debt cycle, and then laying both of them on top of the productivity growth line, gives a reasonably good template for seeing where we've been, where we are now, and where we're probably headed. So, in summary, there are 3 rules of thumb that I'd like you to take away from this. First, don't have debt rise faster than income, because your debt burdens will eventually crush you.
This is actually rather good advice, although the earlier claim that interest rates being higher than income growth would cause debts to rise constantly is a big load of bull.
Second, don't have income rise faster than productivity, because you'll eventually become uncompetitive.
In terms of real income growth, this is very true for our national economy, and it is interesting that Ray didn't go deeper into this matter earlier. If exchange rates or wages are allowed to float freely, they usually correct these imbalances in real income by themselves. However, if nominal income within a nation rises faster than productivity, that just means inflation.
And third, do all that you can to raise your productivity, because in the long run, that's what matters most.
This would be great advice for both individuals and policymakers, but unfortunately in our current economy, where work is quantized into jobs, increased productivity causes an increased need to try to spur economic growth by any means to create more work in order for there to be enough of it for everyone to avoid unemployment. Therefore, increased productivity causes a lot of trouble if people don't want to increase their spending. However, if we remove the quantization of labor into jobs by making sharing work profitable for employers, increasing one's productivity would always be a good idea, as it could also alternatively facilitate more free time.
This is simple advice for you, and it's simple advice for policymakers. You might be surprised, but most people, including most policymakers, don't pay enough attention to this.
I cannot express how much I agree with Ray on this one.
This template has worked for me, and I hope it will work for you. Thank you.
And thank you, Ray, for providing this important opportunity to demonstrate how terribly lost policymakers and even bankers are regarding our current monetary system. More sources and clarifications on these brief comments and alternatives in the upcoming book Fixing the Root Bug and at therootbug.org.